Welcome to Markets Radar with Jeremy Quintanilla. My name is Jeremy Quintanilla, and this is a show all about markets, stock, cryptos, bonds, anything really, and everything in between. And I give you my take on what I think it may all mean. Thank you so much for tuning in. If you're new to Age of Jeremy, this is a segment called Markets Radar, where I talk about what I just mentioned. On my main feed, where episodes come out on Wednesdays, the Age of Jeremy, I talk about all the learnings that I have from my business adventures and side quests. So if you want to get everything Age of Jeremy, you can follow me on Instagram at Age of Jeremy and subscribe to my broadcast channel, Dope Insights and Updates. I am the owner of a few businesses, 3T Warrior Academy, Blockheads, which brings you Merlin, the smartest way to track your crypto, along with Age of Radio, one of the businesses that I absolutely love, which is a media company that provides the podcast network for everyone through our Age of Radio podcast network. So if you're interested in that, reach out to me as well. And then I also have Q Financial. So if you need advice with taxes, bookkeeping, reach out to me, and one of our tax accounting and bookkeepers will help you out. And we do insurance through Freedom Insurance. We have 6 agents. If you are interested in learning more about IUL, reach out to me so I can get you in contact with one of our amazing agents to show you how to protect your wealth using Index Universal Life Insurance. This, again, is your premier destination for everything happening across stocks, bonds, crypto, and all the financial spaces in between. We're zooming in on some dramatic reversals that has caught a lot of retail and professional investors completely off guard. We're going to talk about the Trump trade. We're going to talk about the markets race heats up for prediction markets as Robinhood steps into the game. We're going to talk about BitMEX's shutting it down in our crypto segment. And also we are going to talk about what is going on with gold. So let's dive in. If you've been active in these markets this year, you know that one of the biggest talking points has been the Trump trade. When Donald Trump was elected to a second term, traders of all stripes scrambled to buy up assets that would supposedly ride the wave of his aggressive economic policies. And at first, this trade looked like an absolute genius move, similar to, if you guys know that Nancy Pelosi, you could watch what Nancy Pelosi was investing in, a similar kind of concept here. But as of late July 2026, the tables, except these weren't what he was investing in, it's what people thought would do well when he became president. And again, I want the president to succeed because I want the US to succeed, but it's hard for me to root for Trump. So I'm kind of grinning that this hasn't worked out because as of late July 2026, these tables have completely turned. The shield of the Trump trade is cracked, and today I'm going to break down exactly why this highly publicized trade is turning into a massive loser for those who bet the house on it. So let's look at the hard data. At the beginning of 2026, the Trump trade was clobbering the broader market. Amateur and institutional money alike rushed into the sectors expected to benefit from White House policies like home building, defense spending, and domestic reshoring of manufacturing. To track this, Ned Davis Research put together a dedicated Trump trade index, which consists of a dozen exchange-traded funds or ETFs specifically selected as policy beneficiaries. Through the first 3 months of the year, the index was absolutely flying, posting double-digit gains, and we saw some stellar runs from specialized funds, the Van Eck Rare Earth Metals, which is one that I own, or it's called Van Eck Rare Earth and Strategic Metals ETF, the Global X Uranium ETF, which I own, and the Global X Defense Tech ETF, which I do not own. We're all up at least 20% at their quarter one peaks, carrying some of those gains right into the second quarter. But if you look at the screens now, the outperformance has evaporated. Since its peak in May, the Trump Trade Index has plunged about 16%. Several of those powerhouse ETFs that were up 20% just a few months ago have completely erased their gains and flipped into the red for the year. Meanwhile, the broader market, or the S&P 500, is sitting up about 8%. So what went wrong? Why did a trade that seemed to be bulletproof because Trump gets what Trump wants, promises kept, as people say? And as you know, I'm not a fan of Trump, as I continue to mention that. And I don't think that you should be either, because he's a piece of shit, in my opinion. But according to chief strategists, this is not a random market correction. It is the direct result of massive macroeconomic shifts. The primary culprit is the ongoing U.S. conflict with Iran. When the war broke out, it threw a massive wrench into global markets. The conflict has pushed up energy prices, spiked inflation expectations, driven interest rates higher, and sent the US dollar soaring. And as Ned Davis research pointed out this week, all of this is deeply tied to that Iran war and the resulting inflation shocks. Pat Shoshik, the chief thematic strategist at Ned Davis, captured the frustration of Wall Street perfectly in a report this week when he asked, could we just get 3 months without some sort of supply shock? Between tariffs, war, or supply chain disruptions, we can't get an inflation break. And he's absolutely right. The inflation surge has had a devastating cyclical impact. It has hammered manufacturing and completely cooled off housing and investment. At the same time, traditional cyclical sectors, which are supposed to be the crown jewel of Trump's agenda, have been starved of capital because investors are pouring money into high-performing AI investing themes instead. As Matt Gherkin, chief geopolitical strategist at BCA Research, noted, investors who bet on AI and against traditional cyclical sectors came out on top, while those who bought into Trump as a champion of domestic heavy industry and working class consumption have really taken a beating. And the reason why is because what the United States creates in the world is education, and it used to create a lot of IP, but now it creates intellectual property and software. If you look at your iPhone, right, it says on the iPhone designed in California, right, or wherever Apple is. It doesn't say designed and made in California. The United States is not a place where manufacturing exists. I'm not saying that it shouldn't exist. I think we should be doing certain things like building our own TPUs, building our own data infrastructure, building our own processing chips so that we win. But again, what does that go back to? That goes back to intellectual property and software. And that's what ends up winning in the United States. Now, if you guys follow Trump, because I know there are a lot of people in the world that follow Trump, and again, I don't think there's anything wrong with anybody that follows Trump. I think just I would relook at your values. Truth Social-branded God Bless America ETF trades under the ticker YALL, and it's underperforming also. It's down over 4% this year, while the S&P 500 is up 8%. And more importantly, does buying this ETF mean you actually own shares in Donald Trump's media company, Trump Media and Technology Group? So if we look at all of this, no, the YALL ETF does not own a single share of Trump Media and Technology Group Core. Even though it carries the Truth Social branding, the fund actually holdings are heavily focused on traditional sectors. Again, energy, industrials, and financials. It was designed to give investors outsized exposure to the core pillars of the domestic U.S. economy. So why is YALL tanking? Because of the exact geopolitical forces we just discussed. The war with Iran has triggered a steady stream of net outflows from the fund every single month since the conflict began. Investors are panicking and abandoning cyclical trades. And so if we look at Trump Media and Technology Group itself, the actual company behind Truth Social, that stock has had a fucking horrible year, repeatedly hitting record lows, and sits down about 35% year to date, despite staging a minor rally this month. So whether you look at the branded ETF, which is down 4%, or the actual stock, which is down 35%, the brand associated with these policies have been heavily punished by the realities of inflation and the realities of war. Now, I will always give credit where credit's due, even though I think no one should give credit for Trump, but there is one notable exception that is bucking the trend, and that is the Point Bridge America First ETF, trading under the very famous ticker MAGA. Unlike YALL, the MAGA ETF actually dropped less than the broader market when the Iran war kicked off in March, and it has managed to stay in positive territory for the year, keeping pace with the S&P 500. So why is there a difference? Well, Hal Lambert, the founder of Point Bridge Capital, explained it pretty well. He noted that the Iran war is causing serious anxiety around energy prices, but because there is a very concentration of energy stock exposure inside the MAGA ETF, that energy tailwind has helped the fund stay afloat and match the S&P 500's returns. But even with MAGA holding its ground, the wider policy landscape is becoming incredibly messy for investors to navigate. Since the inauguration, traders have been forced to chase a constant stream of social media posts and executive orders, only to watch the administration walk back plans or pivot entirely because they're going all over the place. Michael O'Rourke over at Jones Trading put it bluntly, investors are getting so exhausted trying to handicap these unpredictable policy shifts that many are simply shutting them out entirely. And in my opinion, that is what you should do, and why I'm always focusing on people taking the sovereignty over their own wealth and going after the things that they actually enjoy. If you enjoy these things and you enjoy giving your money on Trump, then I'm not going to I guess demonize you or anything. That's what you want to do. But if you look and understand markets and trading and investing, these are just not good plays, in my opinion. And I could be wrong. I hope that I'm wrong for all the people that have lost money in these, that they make their money back. But I just don't see anything beneficial with the MAGA movement, specifically while Trump is the one that's in power of the movement right now. That's my personal opinion. That doesn't mean that I don't think that Donald Trump or Jared Kushner or Eric Trump could do a better job, or Barron Trump even. I'm not saying that. I'm just saying right now, Trump shouldn't be the one that's leading this. Just this week, the administration made a major move, replacing the temporary expired 10% global tariff on goods entering the U.S. with targeted actions under Section 338 of the Tariff Act of 1930. And Trump didn't really pull any punches. He hit Canada, our largest single export market, with 50% tariffs on a massive range of products, including everything from beer and wine to paper and even hockey sticks. Analysts are already warning that Europe and China are the next targeted bullseye for the Section 338 tariffs. On paper, this is a classic America First policy, but in the real world, market strategists are super concerned. Let's talk about Mark Melich, the chief investment officer at Muriel Seibert, issued a strong warning stating now is really not the time to be pressing this. Why? Because inflation is already elevated, oil prices are high, and the corporate profit margins that have supported the bull market are starting to look vulnerable. Malik points out that the market has already rallied despite the Strait of Hormuz being shut due to the Iran war, essentially using up its only get out of jail card. Pressing tariffs now could push the economy over the edge. And if you follow us, you know that inflation is the first hurdle that you have to beat. So you want things that are not going to increase inflation, because the only way to curb inflation is to essentially tax people and raise interest rates. And we are not doing either of those. Well, I believe that at the end of the quarter, Warsh will go ahead and who's in charge of the Fed, he will probably do an increase at the end of the year, in my opinion. If you ask some diehard backers of these policies, like Point Bridge's Hal Lambert, they'll tell you it's a mistake to abandon the trade now. He says it's a long-term play. You don't build a manufacturing facility overnight, and structurally, he may be right. Policy shifts of this scale take years to bear fruit, but for the short term, traders and retail investors are on the street. The immediate reality is painful. Actually, I personally don't agree. He might be right. I don't know. But again, I don't think that these are good long-term plays. I think there's much better plays, or you could just do better by investing in the S&P 500. Okay, you could go and buy a spider share, which is the one that I use. I forgot the ticker symbol for it. And that is one of the best ways to get started investing, by buying some of those and then starting to research companies that you like and then buying in on some of those companies. The other thing that you could look at if you're getting into investing is look at some really good dividend producing ETFs, work on those, take that dividends out, and then use those dividends to buy something else. That's the way in which we utilize our capital DR strategy in the 3T Warrior Academy. And if you're interested in that, go follow Coach JV _ on social media and watch us on the Coach JV YouTube channel. You can also listen to the Coach JV podcast. Lots of Coach JV stuff that's going on. We'll be right back. If you have spent any time in the crypto markets over the last decade, you know the name BitMEX. It's BITMEX. This was the legendary platform that quite literally changed how the entire world traded digital assets. They were the pioneers of high risk, high reward trading, introducing products that defined a generation of speculation. But we just received word that the giant is officially failing. After a prolonged downturn that has shaken the foundation of the industry, BitMEX is shutting down operations completely. We're going to look into the rise, the regulatory battles, and the political twists, and the final structural collapse of the exchange that taught the world how to use 100 times leverage. And as you know, how should we use leverage? Anybody who continues to follow me, we use leverage to buy assets that create income that can pay off the leverage and then produce cash flow into the future. That is the model. That is what we teach in Capital DR. So again, check us out at 32 Warrior Academy or Coach JV _ or Coach JV YouTube or Coach JV podcast. To understand why this shutdown is such a massive deal, we have to go back to the beginning. BitMEX was founded in 2014 by a powerhouse trio, former Citigroup equities trader Arthur Hayes, along with Ben Dello and Samuel Reed. At the time, the crypto trading was relatively basic, but these three men transformed the landscape by introducing something called perpetual futures contracts, commonly known as perps. Horrible name for it. Unlike traditional futures, these perpetual contracts have no expiration date. Instead, they use a clever funding rate mechanism to continuously tie their price directly to the underlying asset. Crucially, BitMEX offered traders the ability to use up to 100 times leverage on Bitcoin. The single product was a total game changer. It turned BitMEX into the dominant epicenter of high-risk speculation. During the historic crypto boom from 2017 to 2020, BitMEX was one of the largest cryptocurrency exchanges on the planet. To give you an idea of the sheer scale they achieved, in June of 2019, Arthur Hayes tweeted that the exchange had handled a staggering $1 trillion in trading volume over the preceding 12 months. Today, perpetual contracts account for the overwhelming majority of crypto derivatives trading volume globally. Massive platforms like Binance, Bybit, OKX, and Hyperliquid built their entire business empires around the exact perp product that BitMEX pioneered. The concept has even spread far beyond crypto, now covering traditional markets like oil and equities. Arthur Hayes became one of the crypto's ultimate rock stars, and to this day, his market commentary is closely watched by investors worldwide. But as we often see when platforms offer 100x leverage, the higher you fly, the harder you fall. And BitMEX's dominant position began to crumble in 2020. United States regulators stepped in, accusing the exchange and its founders of violating the Bank Secrecy Act by failing to build and implement an adequate anti-money laundering program. The legal pressure was relentless. By 2020, the three founders had left the company. Then came the guilty pleas. In 2022, Hayes, Dello, and Reed all pleaded guilty, agreeing to forfeit $10 million each. BitMEX, as an organization, later agreed to a massive $100 million settlement. Even though the legal battles eventually quieted down, the damage to the brand was already done. Trust is the ultimate currency in finance. During these prolonged legal troubles, investors panicked. They fled the exchange in droves. But despite their best efforts to rebuild BitMEX, it was never able to regain its crown or return to its former dominant market position. So if we look at where it is at today, we can look at the strange anomalies in the financial world and answer some of the biggest questions. If BitMEX and its founders were officially pardoned by Donald Trump last year, and they even had an incredibly lucrative business connection to him, why didn't that political shift save them? And why are they winding down the operations now? Because you think if you tie yourself into Trump, or you make reference that you know Trump, that Trump is going to save you. And he did pardon them, but does that mean that he gave a shit about BitMEX? So if we look at the facts, it's true that when BitMEX's massive legal bills came due last year, Donald Trump stepped in and pardoned the company and its founders, a highly unusual move for a dickhead president, or what other people would call a modern president. And the ties went deep. In January of 2025, right before the pardon, BitMEX launched a swap listing tied directly to Trump's meme coin. The listing was part of a large business venture that earned the president a massive $636 million last year. Arthur Hayes even wrote an extensive essay arguing that Trump's embrace of meme coins would actually bolster political accountability, which is ridiculous. So why are they closing? Because a presidential pardon can erase your legal penalties, but it cannot force investors to bring their money back to a damaged piece of shit platform. The reality is that the crypto market entered a severe downturn after a sharp sell-off last October. Bitcoin has lost more than half of its value, plunging from its peak of over $126,000. While larger, deep-pocketed rivals like Binance were better equipped to ride out this brutal winter, BitMEX was already weak. At the same time, newer decentralized platforms like Hyperliquid began eating them up, capturing market share by offering much lower fees on the very perpetual products that BitMEX had invented. So the answer is simple. Political favors can keep you out of court, but they cannot save you from high fees, fierce competition, a punishing bear market, and as I always like to say, and this is the only thing that I will ever quote from Atlas Shrugged, is that looters get caught in the end. She's using it for poor people. I'm using it for these assholes. So she had the right idea. I think she was targeting her energy at the wrong people, but it's just my opinion. The struggle behind the scenes became painfully obvious in recent months, especially when we look at the executive suite. Just last month, BitMEX suffered an absolute exodus of its top leadership. In a stunningly short period, Chief Executive Officer Stephen Lutz, Chief Financial Officer Ina Steiner, and Chief Growth Officer Raphael Polanski all walked out the door and left the company. When your CEO, CFO, and CGO, or Chief Growth Officer, all abandon ship at the exact same time, it is usually a clear sign that the writing is on the wall. Without executive leadership to steer the ship through the ongoing crypto winter, the exchange was left entirely vulnerable. The larger centralized rivals had already overtaken BitMEX in trading volume years ago, and with decentralized alternatives offering lower fees and more transparency, the original home of the perp simply had no remaining cards to play. According to an official blog post from the exchange, which is owned by HDR Global Trading Ltd, the wind down is already active. The company has officially stopped accepting all new account registrations. If you currently have capital on the platform, you need to mark your calendars. BitMEX is scheduled to close its doors for good on September 23rd, 2026. In a highly symbolic date, the exchange had practically created the modern crypto trading infrastructure, is given its users just under 2 months to wrap up their accounts, close their positions, and withdraw their funds. When we look back at the legacy of BitMEX, it's a story of incredible innovation, but it's mixed with a harsh lesson in risk. They gave the retail trader institutional grade weapons, right? Because you need to take sovereignty over your own wealth and your own understanding. It gave them the weapon to 100x leverage, and it changed the plumbing of global derivatives forever and created a multi-trillion-dollar product in the perpetual swap. But in the end, regulatory pressure, executive departures, cheaper decentralized rivals, and a massive market turndown proved to be a lethal combination that even a presidential pardon couldn't cure. Let me know what you think about the end of BitMEX. Did you ever trade on the platform? Hit me up on comments down below for this episode. Or did you move over to a decentralized perp long ago? Just make sure that you're trading safe, managing your leverage, and we'll be right back.
Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out that's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3 months, $90 for 6 months, or $180 for 12-month plan required. $15 per month equivalent. Taxes and fees extra. Initial plan term only. Greater than 50 gigabytes may slow when network is busy. See terms.
For years, placing yes or no bets on real-world events was seen as a niche corner of the internet. But over the last year, it has exploded into a multi-billion-dollar industry. Everyday traders are no longer just betting on whether a stock will go up or down. They are betting on interest rate cuts, sporting events, and geopolitical outcomes. And right now, the massive corporate arms race is heating up. We have just learned that retail brokerage giant Robinhood is in active talks with crypto powerhouse Crypto.com. This single deal has the potential to completely reshape how millions of retail investors interact with event-based contracts, and it's setting up direct high-stakes clash with the current kings in that specific space. Let's look at the mechanics of the potential deal. According to people familiar with the matter, Robinhood is in talks with Crypto.com to significantly expand its foothold in the prediction markets business. Now, if you aren't familiar with prediction markets, a prediction market is essentially where you can bet on anything that's happening inside of the marketplace. If you think that we're going to have a recession in 2027, you can bet on it. If you think that the world is going to end by 2030, you could probably bet on it. That's what a prediction market is. The two biggest ones are Kalshi and Polymarket. Now, if you use Robinhood, you know they already let you place yes or no bets on the trading platform. But currently, Robinhood has had to rely on external exchanges, primarily Kalshi, to supply those events-based betting contracts. The partnership being negotiated with Crypto.com would change that game entirely. It would add Crypto.com's own prediction market contracts directly to Robinhood's platform, allowing Robinhood's massive user base to seamlessly trade contracts generated by the crypto exchange. Why is Robinhood doing this? It all comes down to control and also variety. Robinhood spokesperson recently stated that the company will continue to partner with multiple exchanges to ensure our customers have access to a diverse and resilient marketplace. But behind the scenes, this is a clear effort by Robinhood to build its own independent prediction markets hub and reduce its reliance on any single partner. The volume Kalshi is pulling in right now is absolutely staggering. To give you some context on the sheer scale of retail interest, Kalshi saw a mind-blowing 27 billion trading volumes form market related to the World Cup. $27 billion in trading volumes for the World Cup. Contrast that with the Super Bowl, which it was about $1 billion in volume, and you can quickly realize that the global appetite for event-based contrast is vast. Kalshi also recently launched perpetual futures or perps, which never expire and allow traders to pile heavily leverage onto their bets. These perps have already drawn billions of dollars in volume. Up until recently, Robinhood and Kalshi were close allies, with Robinhood acting as a major distribution channel for Kalshi contracts, but that partnership is rapidly evolving into direct bare-knuckle competition. Kalshi CEO Tariq Mansour addressed this head-on, noting that he considers Robinhood to be a top competitor, stating, "They're a partner of ours. At the same time, they're competing with us, and I think that is also great." Now, Crypto.com announced a massive partnership with Donald Trump's media company late last year to bring prediction markets to Truth Social. So if they already have that major partnership, why is Crypto.com trying to cut a deal with Robinhood now, and what does that mean for Truth Social? First, the facts. It is absolutely true that in late 2025, Crypto.com announced a highly publicized partnership with President Trump's media business. The plan was to introduce prediction markets directly onto the Truth Social platform, but that offering has not yet launched. Meanwhile, Crypto.com has been aggressively building out its own independent infrastructure. Back in late 2024, they began offering prediction contracts through their derivatives arm, and in February of the year, they launched their own standalone prediction markets platform called OG. So why is Crypto.com talking to Robinhood? Because Crypto.com has a fully functional, highly advanced prediction engine in OG, but they need massive retail distribution to compete with Kalshi. While the True Social integration remains in limbo, Robinhood represents an immediate massive pipeline of active retail traders. For Crypto.com, partnering with Robinhood is no brainer. It monetizes their derivatives engine immediately. So for Robinhood, it gives them another major partner so they aren't held hostage by Kalshi. And for True Social, it shows that in the fast-moving world of fintech, a press release from last year doesn't stop your partners from chasing the immediate retail volumes as of today. So if we come back to Robinhood's broader strategy, they're not just betting on Crypto.com. They are building a highly diversified network of partners to squeeze their competitors. Beyond Kalshi, Robinhood has quietly integrated interactive brokers, ForecastX, and a highly specialized exchange called Rothera. Now, Rothera is a futures and derivatives exchange that is managed through Robinhood's joint venture with Susquehanna International Group. It launched earlier this year, and its impact was felt almost immediately. So those, again, are ForecastX Forecast X and Rothera. According to market and analysts, since Rothera went live, Robinhood's customers have accounted for a steadily decreasing portion of Kalshi's trading volumes. This is a massive structural shift. By routing their users' trades through their own joint venture, exchange Rothera, and potentially adding cryptos.com contracts to the mix, Robinhood is systematically clawing back market share and keeping those lucrative trading fees in-house. So again, one of the things that when you're a business owner, you want to look at is the diversification of the revenue and the infrastructure in which you have. And really, this is Robinhood really trying to focus on that. If you look at the strategy of the market leader, Kalshi isn't backing down. Their CEO, Tariq Mansour, has made it clear that the company plans to expand its array of tradable assets for far beyond just traditional event-based contracts. By combining perpetual futures, which allow for highly leveraged non-expiring trades with a broader suite of assets, Kalshi is trying to evolve from a simple prediction market into a full-scale financial exchange. But as Robinhood builds out its own independent prediction markets hub, the giants like Crypto.com and Susquehanna, the competitive moat around Kalshi is shrinking. The retail investor is the ultimate winner here, as this fierce competition is driving lower fees, more advanced trading tools, and an almost limitless variety of things you can trade, where when people ask me, why am I against capitalism? Am I against free markets? You can be for free markets because free markets allow for this specifically, where capitalism is an ownership and profit sharing issue and control issue. The prediction market gold rush is currently here. Whether you were betting on interest rates, the next election, or the World Cup, the lines between traditional trading, crypto speculation, and event wagering have completely blurred. But remember, when you pile leverage onto these yes or no contracts, the risk is real. As the platforms fight for your volume, make sure you are managing your capital wisely. And we'll be right back to close out the show. The gold rush is on in prediction markets, and the gold rush might be over for, well, gold. Historically, gold is the ultimate safe haven. When geopolitical chaos strikes and inflation spikes, you buy gold to protect your wealth. But look at what has happened since the US-Iran war broke out on February 28th. Gold is tanked 22%. It comes down to the Federal Reserve and the battle for yield because the conflict is driving up energy prices and inflation. Investors are heavily betting that the Fed will have to raise interest rates to cool things down. Since gold pays absolutely zero yield, higher interest rates makes holding cash or short-term bonds much more attractive. Historically, gold only shines when real inflation-adjusted interest rates are falling. At the same time, we can see desperate moves behind the scenes. Rumors have swindled that Middle Eastern central banks have been dumping gold to raise immediate cash during the crisis. We know for a fact that Turkey's central bank sold a massive 81 metric tons of gold in the first half of this year, unloading 10.6 billion worth of reserves. If central banks are dumping gold and the Fed is threatening to raise rates, isn't gold's reputation as a crisis hedge officially dead? No, that's not true, and it's far from it. In fact, the underlying data tells us a completely different story. Let's look at the central bank sales. The fact that a country like Turkey could instantly mobilize and sell $10.6 billion of gold for cash in the middle of a war doesn't prove gold is useless. It proves it is the same ultimate liquid reserve asset when the chips are down. And while Turkey sold, other nations are aggressively buying. Poland was actually the largest net buyer of gold in the first half of the year as central banks look to diversify away from the US dollar and insulate themselves from geopolitical risks. Furthermore, if we look at the Fed, the market is priced in a 50% chance of a rate hike by September, but we have a brand new Fed chairman, Kevin Warsh, who I mentioned earlier in this episode, who is incredibly circumspect with his communications and hates giving forward guidance. He's waiting on slow-moving task force that might not report back until the end of the year. If the Fed finds itself flat-footed and moves too slowly to combat the oil price shock, inflation will outpace rate hikes. Or if the flying high AI stock boom suddenly fizzles, the Fed may be forced to cut rates even while oil prices remain high. In either scenario, real interest rates fall and gold is poised to rocket upward. Equity investors are currently living in a dream world. The stock market is kept marching upward, fueled by massive unchecked optimism around artificial intelligence. Wall Street is remarkably complacent about the severe risk of the ongoing Iran conflict and escalating oil prices. So we need to remember that despite its recent dip, gold is still up 21% over the past 12 months, slightly outperforming the S&P 500. When the stock market is priced for a perfect Goldilocks world, keeping an allocation in gold to hedge against the unforeseen isn't just conservative, it's also highly rational. Buying the dip here gives you a heavily discounted shield before the market's complacency inevitably breaks. Now, again, I own gold. I stopped buying gold right around the time, and silver right around the time that it fell. And this might be the time that I'm going to start buying, and it might be a good time for you to start buying. Thank you so much for listening to Markets Radar. All of these articles from today came from Bloomberg, so go check out bloomberg.com. I'll work to start citing some of these sources in the episode description so you can go read them. I'm a very big news nerd, and I love business and finance and news in general, mainly economic news. And so I recommend that you go and read those on a regular basis. We had to do it in finance school, and so I continued that for the most part up until recently, or up until today, I guess I could say. Make sure that you follow me on Age of Jeremy. Make sure that you listen to the New Wealth Transfer podcast on the CJV channel. Also, I'll be on the War Room next week, which is a show on the Coach JV channel. So go check that out as well. That goes live at 8 on Monday, Wednesday, Friday. I will be running the show this coming Friday and then the following Monday. And don't forget, another Markets Radar episode will be out on Tuesday, and then an Age of Jeremy episode will be out on Wednesday as well. And as I always say, be thankful, grateful, and kind, and we'll talk with you soon. Bye.